India is primed for a big rally, so why multi-asset rather than pure equity?
Only 6 out of 12 times has equity outperformed the other two asset classes.
I see.
Now imagine at that point of time, if there was a way of kind of dynamically allocating, taking some money off the table, reallocating it to some other asset class. If the conditions are dynamic, then why should you have or play the same 11 all the time?
That's right.
So on a weekly basis, we can readjust our asset allocation. The model can potentially keep adapting with the market situations.
Hello and welcome to the Fine Print. I am today with Bhautik Ambani, who is CEO of AlphaGrep Mutual Fund, on the launch of their first scheme, which is the multi-asset scheme. So Bhautik, first question to you is, people have not seen returns on the equity side for 18 months. They are saying India is primed for a big rally. So why multi-asset rather than pure equity?
Just before that, thank you so much for being with us again, Neil. Really good to see you. Pleasure is ours to have you over. Yes, so let's kick off with why multi-asset, right? Like, why did we think of that as the first strategy? See, when you think about it, a lot of people spend a lot of time on deciding on which stocks to buy or sell in the portfolio, which means that in the first place they've decided that my allocation has to go to equities, right? Whereas there is enough and more empirical evidence which basically shows that a large part of the alpha can be generated by just having the right asset allocation.
Sure.
Right. And the other thing is that if you think about it, like, are investors waking up every day saying that, oh, I have to invest in equities? Or what bothers them more is, where can I create wealth over a period of time with certain amount of consistency and gives me the less or the least amount of anxiety? Right. And that's exactly what we are trying to solve for with the multi-asset fund.
Right.
Right? Because, so let me give you some data here, right? So if you look at the last 20 years, Indian markets, we actually compared the performance of 3 asset classes.
Okay.
So Nifty as a proxy for equity, gold as largely a proxy for commodities, and fixed income.
Right.
Okay. And we broke these last 20 years into broadly shorter economic cycles.
Okay.
When I say economic cycles, let's say GFC, couple of years, recovery from GFC.
Yes.
Then you had the Eurozone crisis.
Yes.
Then you had, let's say, the taper tantrum.
Correct.
IL&FS crisis. So, similarly, let's say Russia-Ukraine 22. So many such
Pandemic itself.
Yes. So many such short periods have kind of panned out. Right? And when we broke it down into 12 such cycles, what we realized, and when we compared the performance of the 3 asset classes, what we realized was that only 6 out of 12 times has equity outperformed the other 2 asset classes.
I see.
Okay, which means only 50% of the times is equity the best performing asset class. Okay, the balance 50% of the times it's largely commodities which has done better. Okay, so the other thing that we generally think is that, oh, the last 2 year rally that we've seen in gold or silver is the only period when gold or silver has done well in the last 20 years. That's actually not the case. There have been many such other periods when gold and silver has done well. That's one. Or commodities done well. The other thing is that periods when equity has not done well have been usually linked to some kind of a crisis or a problem in the markets. And the drawdowns that you've seen in equity in those periods has been very, very sharp. Like, for example, in GFC, global financial crisis in 2008, we saw a 60% drawdown. 11, we saw a sharp drawdown. Similarly, we've seen other such drawdowns in the last 20 years. Right? A lot of times we tend to kind of forget this because in the last 10 years, we've not seen any such sharp drawdowns, correct?
Very briefly for COVID, but it just bounced back.
Yes. So, which, to be honest, like before people could even blink their eye, it just kind of bounced back, right? So when you think about it, markets can go through these patches cycles, okay? Now, if we just rely on one asset class to do the job for us, which is equities, right? That means that we're doing 2 things. One is that, let's say, half the periods when equity is not doing well, right, we are actually kind of creating a portfolio which may just underperform. Okay, may not give you the best results. And the second thing that is happening is that by not taking money off the table at certain points in time, you are, a lot of times you're just having paper profits.
Yeah.
Like, for example, today, right, people who invested, to your point, people who invested in equity markets, let's say 4 years back, right, till about 2 years back, they were looking at way better CAGRs or IRRs on their portfolio.
Yes.
Today, the same IRRs are not there, right? They're looking at much lower IRRs.
Correct.
Right? So what was looking really good is probably looking mediocre today.
Sure.
Okay. Now imagine at that point of time, if there was a way of kind of dynamically allocating, taking some money off the table, reallocating it to some other asset class, right? Would the portfolio overall result look better or not? That's point number one.
Basically, you would lose less money.
You lose less money or maybe even have a better return, because what would happen is that A, you would have not, had like a flat period for 2 years. Two, let's say you had moved some of this money into commodities or fixed income, your IRRs would definitely be better, na?
Yeah.
So that's the opportunity cost in very simple terms.
Correct.
So let's say we're sitting in this room, you have a thermostat which is controlling the AC, right?
Yeah.
Now, imagine the thermostat is constantly keeping the temperature at a certain level.
Yeah.
Right? And not adjusting to, the environment in the room.
Correct.
Now, that's like saying that under any market condition, I will only keep an X amount of money in equities and I will only rely on that one asset class to do the job for me.
Yeah.
Okay. Or another example could be, let's say India playing the same 11 in India, in Australia, in England. The conditions are different.
Absolutely.
Right? So if the conditions are dynamic, then why should you have or play the same 11 all the time?
Absolutely. So Bhautik, can you give us a glimpse into the model? How would you switch between asset classes?
Sure. So before I come to the model, let me give you a sense of what flexibility have we built in. Okay. Ultimately,
Sure.
When we are saying that it's dynamic, so what kind of dynamism can we use out here?
Sure.
Right. So as of today, we have 3 asset classes. So equities, commodities, fixed income.
Yeah.
The SID is enabled for investing internationally, but as and when, let's say, the limit opens up for the industries, when we will invest internationally.
Agreed.
So let's look at the 3 asset classes today that we have. In equities and fixed income, the flexibility that we have in terms of net exposure is from as low as 10% to 60%. Similarly, on commodities, our range is from a 10% to a 40%.
Right.
Now, one is the flexibility. We'll talk about exposures, but I'll just tell you that this flexibility is just to not have it on paper. When we look at the backtested results of the model is actually used, the entire min-max range in different periods.
Right. Just to clarify one thing though, debt will not exceed 35%, right? Because that ensures that your fund stays 12.5% long term after 2 years.
Okay. So let me clarify on the taxation. At a gross exposure level, equity will be between 35 to 65.
Right.
Which means that our long-term capital gain, 12.5% kicks off after a 2-year holding period.
Sure.
Right. So it's not 1 year holding period. It's a 2-year holding period for somebody to enjoy a long-term capital gain benefit in this fund. So just coming back.
So how the model will operate?
Yes. So coming back to that. So like I said, one is this is the flexibility that we have. The second part is that when you look at the historical backtested results, we've had single year periods. Okay, at least I remember one very evidently. In that same 12-month period, our model was as low as 11% equity exposure and took it up to 55% within a 12-month period. Okay. Just give you examples of dynamism.
Yeah.
There's another month where from 1 month to another month, equity exposure jumped up by 20%. Now, the reason I'm mentioning this, is that our rebalancing model is the starting point is a statistical model.
Yeah.
And it's not valuation based.
Sure.
Okay. So that is what makes a big difference. Now, when I say statistical model, so there are a couple of approaches that we deploy here. One which is called risk parity, other which is called sharp optimization. These are not new to the market. Okay. These are common approaches that are followed globally. These are approaches that we follow at a group level. So these are very common approaches, statistical approaches. Okay. So we've taken a subset of some of those models, right? Which we also have an experience of, let's say, at a group level, and kind of deployed it for the mutual fund. Okay. Now, just to explain in very simple terms. Okay. Now, let's say if I have to give again an anecdotal evidence here. Let's say if you were to be given a choice saying that 2 cars, one which offers highest speed, and let's say I choose a Ferrari. Right?
Sure.
I'm saying that gives me like really fast speed.
Yeah.
Right. On the other side, I'm saying I want speed, but I also want to look at mileage. So I'll probably choose an EV or a Tesla.
Sure.
Right. which will give me speed plus along with a good mileage.
Yeah.
That's what we are trying to do in our model. We are marrying risk and return both,
Right.
rather than just only looking at returns.
Sure.
Okay, so that in some sense, the sharp optimization approach does. So what it does is that at any point of time, if a particular asset class, if the risk increases, which means the volatility, let's say, increases, then the model automatically kind of readjusts the exposure.
I see.
So that no single asset class, right, at any point of time is overbearing on the portfolio from a risk allocation point of view.
Sure.
Okay, so what that does is two things. One is it kind of brings stability because you have, let's say, enough and more exposure across multiple asset classes rather than just relying on one.
Yeah.
Okay. And the second thing is that whenever, let's say, volatility goes up, that in some sense is giving you a measure of risk, right?
True.
For a particular asset class.
Very true.
And that the model automatically brings that exposure down for that particular asset class. Okay, so this is something that it keeps readjusting. Now, what I also want to mention out here is that because this is statistical, we don't necessarily look at, to take these decisions, we don't necessarily look at like 10-year data and take decisions on that. Maybe for our valuation or for our macro data, we do look at long-term data. But for some of these statistical models, we don't look at very long-term data. This is more recent data.
Okay.
Let's say 3 months to 12 months, that kind of information. Because of that, we are able to adjust exposure faster. So for example, our entire asset allocation model, the rebalancing frequency is weekly. So on a weekly basis, we can readjust our asset allocation.
Right.
And because we're looking at shorter term data, the other thing that happens is that the model can potentially keep adapting with the market situations. Let me give an example of why adapting is important. Okay. See, generally what happens is that we have certain preconceived notions to do with correlations. Okay. And we look at, let's say, 10 years, 15 years, 20 years data saying that, let's say, for example, in US, there was a certain correlation between equity and fixed income, and that correlation will kind of persist in the future. Similarly, let's say we've all learned that every time there is crisis, equity markets correct, gold will give you a good stabilizer at that point of time.
Yeah.
So these are preconceived correlations that we've seen for a number of years or maybe for a few decades,
True.
right, which have held true. But in both these situations, let's take an example of, let's say, equity versus fixed income. In US, you had that common approach of 60-40, which was doing very well for decades.
Yeah.
Right? And then came 2022, right, where 60-40 was generally allocating 60 to equities, 40 to debt.
Correct.
Every time equity markets corrected, fixed income looks like a good stabilizer.
Yeah.
Then came the year 2022.
Interest
Equity
rates,
markets went down. In the same year, interest rates went up. So fixed income also gave like a double-digit negative return. Equity also gave a double-digit negative return, which had probably not happened for like 20, 30, 40 years in the US before that.
True.
Okay. And it's that time and now people have started questioning the 60-40 approach itself. Okay. Similar thing when you see a couple of months back in India, right? Gold versus equities.
Yeah.
Crisis happened in March. Equities went down.
Yeah.
Same period, gold also lost money.
That's true.
Right? And again, every time there was a crisis in the past, that has not happened.
That's true.
So the reason I'm mentioning this is that if we just base our models based on certain historical, preconceived correlations, right? It is possible that we will have these one-offs, or I would not even say one-off. These are like firsts, right? And now you're questioning that maybe this correlation is going to change in the future.
Correct.
So if there are going to be many such firsts in the future, then what we are saying is that we are potentially building a model which will keep adapting to this regime, rather than just rely on, some historical 10, 15, 20-year data.
Got it.
Like another similar thing, just last point I want to mention is around valuations.
Okay.
Right? Like today when we look at valuations or any valuation-based model, what you will logically do is that you look at last 10-year P ratios and say that the last 10-year P ratio in India was, let's say, for example, 18. Right? And if you're building a model around valuation, what you will say is that, let's say anything up below 18, markets will be cheap. Let me increase exposure. Anything above 18, let me bring down exposure to a certain extent. Tell me something, if we were sitting 10 years before this, right?
Yeah.
Let's say in 2016,
Yeah.
would we be looking at looking at 10-year historical data of P ratio before that, would we still be looking at the same P ratio band, or would we be looking at some other averages? I remember it being, closer to 16 when I,
It
entered
was
the
much
industry
lower,
back
yes,
in
yes.
2005.
Agreed.
Right. Now, in 2005, we used to give people an example saying that the historical, median P or average P is 16. So in future, anything above 16 is expensive, below 16 is cheap.
Correct.
Right. And then the next 10 years has actually changed that band itself.
That's true.
Now, do I know what the next 10 years are going to look like? I don't know.
So it's a lot more dynamic.
Exactly.
And I'm assuming that's where your background, your company's background in quantitative methods comes in.
Yeah.
But that immediately brings the question that when you do a weekly rebalance, you're going to have a lot of transaction costs.
Yes.
How do you deal with that?
Yeah. Okay. So a couple of things here, right? So one is, let's say, the TER, right? Or now the base expense ratio. That is defined by SEBI.
Yeah.
So what is applicable to any other multi-asset fund or hybrid multi-asset fund is what is applicable to us.
Yes.
Right. The cap today, that we can charge is 1.85% per annum, which as in when the AUM goes up, it keeps
comes
reducing.
Down. Yeah.
Based on the TER. So that's one. So that is no different to, let's say, any other multi-asset fund which is running in the hybrid category. Second part is, let's say, around transaction cost. Okay, so one of the transaction costs that we may end up incurring higher than others is brokerage.
Yeah.
Now, before I mention this, what is important to understand is just because we can rebalance weekly on asset allocation or we can rebalance daily on security selection, doesn't mean that we have to act every day or every week.
Right.
Okay. So it's only when the model tells us to take a certain decision is when we will be taking that decision. Okay, so that's point number one.
Sure.
And the model will logically only tell us to take that decision when there's a requirement to do it.
Correct. When it outweighs the transaction cost.
Exactly. So that's the first part. Second part is, let's look at transaction cost also. So if you think about it, let's say if there was, a distributor and if there was a client who came to him or her for advice, after giving advice, would that distributor make the client invest in a regular plan or a direct plan in your view?
Regular,
right? Now, let's say there is another investor who has made a decision on his or her own, saying that which fund to invest in. Would that person invest in a regular plan or would rather go to a platform and invest in a direct plan?
Direct,
right? Which means that it's cheaper for that person. And rightly so, because that person is not looking for advice. He's not using somebody else's time, resources, efforts, any of that.
Yeah.
Right? Taking a decision on their own. Similarly, for us, let's say as a mutual fund, okay, when we are going to brokers today, so, while we are just starting, if I'm not getting the number wrong, we have around 20 brokers on the equity side that we're looking to empanel or already empaneled with us. With a lot of them, considering, we are not looking at service or, an engagement that another asset management company would generally require. We've negotiated with almost 8 or 9 of them, okay, at a brokerage cost of 1 basis points on cash equities.
Yeah.
And as you would know, recently SEBI has changed the cap on equity brokerage, which was earlier 12 bips to now 6 bips. Obviously, they've taken certain statutory levies outside of that, but it's still capped at 6 bips. Whereas in our case, we've negotiated with at least, a good almost 40% of them at 1 basis points on cash.
0.01%.
Yes, 1 bips. You're right. So that's something that we've done. So you can yourself imagine, right? Like that itself is going to bring down cost for us.
Yeah. So Bhautik, now tell me about the individual sleeves, equity, debt, commodities. Within that, how do you pick stocks, bonds, etc.?
Sure. So on equities, we have a multi-factor model. It looks at traditional data, it looks at alternative data. When I say traditional, it's a combination of, let's say, fundamental technical data. When I say alternative, it's a combination of, sentiments, flow data, derivatives data. So a lot of data, which is, let's say, relatively faster moving, right? So we do a combination of that. There is a multi-factor model, which also does rebalancing across factors, right? So that's a model which will be rebalancing the equity portfolio on a daily basis. Okay, so that's the equity sleeve. On the commodity side, in terms of exposure or the universe that we're going to start with, is going to be 4 commodities. Okay, so it's going to be gold, silver, copper, and crude. Okay. Again, as a group, as a team, considering we have experience of investing or trading across these commodities.
Right.
That's the reason we've added them.
Through futures.
Through futures. And gold, silver, even through ETFs.
Right.
Correct? So both of these are possible. We have a separate model which will do security selection or commodity selection. And that engine will also run on a daily basis.
I see.
So as you can think about it, layer 1 is asset allocation, which rebalances every week. Layer 2 is security selection, so which is stock selection, commodity selection, which will be rerun on it or rebalanced on a daily basis.
Okay.
On fixed income, we are generally looking to run broadly like a short-term carry portfolio. When I say short-term, you're talking about an average duration of around 2 to 3 years.
I see.
Okay, and run a carry portfolio. And idea is not to take any high amount of or risky credit bets, nor are we looking at taking any long duration bets here.
Sure.
At the portfolio level.
Sure. On the equity component, can you give me a little bit more detail? Would it be large versus SMID? How would that?
Sure. See, considering the fact that, so before I come to that, let me give you some. Should I give you some results around how the portfolios, how the backtest results show?
Yes.
So let me first talk about the allocations.
Sure.
Okay. So when we kind of tested this for 20 years.
Yeah.
Okay. The broad, or let's say the 20-year average allocation to equities, which has come out from this portfolio, is around 30%. Okay. And most multi-asset funds, when I look at the industry, that's closer to 60%.
Absolutely.
So our average allocation for a 20-year period is 30%. Our average allocation to commodities is around 25-26%. The balance is fixed income. Now, whenever somebody hears these numbers, their first thought is very conservative.
Yeah.
Right? And running a very conservative product, returns aren't going to be great.
Yeah.
So then let me give you a glimpse of what the numbers could have potentially looked like. Okay. So before I talk about our return numbers, let me give you a perspective on how Nifty has done over the same period of time. So somebody had just done equity markets.
Yeah.
And let's say Nifty, which is a good proxy to the markets or large caps.
Yes.
Then what would numbers look like?
Sure.
Both on returns and risk.
This is 20 years.
20 years.
20 years. Okay.
So 20 years, Nifty has delivered a CAGR of around 11.5%. With a wall or standard deviation of around 20% annualized.
That's surprisingly high.
Okay. And a peak drawdown of 60%, 60.
That's global financial crisis.
Yes. Let's say if somebody did a static allocation where, let's say out of 100, they put 16 Nifty, 25 in fixed income, 15 in gold, and just did a monthly rebal. Okay, over the last 20 years, same period.
Yeah.
They would have realized a return of around 9.5% CAGR, CAGR, with a wall of 12.5, with broadly a peak drawdown of around 40%.
Sure.
Now, when we tested our model, so asset allocation engine plus security selection engine as a combined thing, has shown us a result where the CAGR over 20 years is 14%. And what is interesting is what happens to risk. Wall or standard deviation of 7.5%, almost a third or less than half of equity. Okay. And the peak drawdown, which I think is the most important for clients or retail clients, of around 13.5%.
That's it.
Yes.
Even in the global financial crisis.
Yes.
So your model is showing a higher return than pure equity and a lower risk than pure equity.
Yes. So that's the reason I'm saying the beauty is that avoiding risk at certain points of time itself can add to compounding, improve risk in a dramatic way. Right?
Yeah.
And B, allocating to the right asset classes at the right time can also improve not just returns but also improve risk. So that's the whole advantage of combining multiple asset classes which have low correlation with each other.
Yeah, because conventional thinking in the industry runs that equity, high risk, high return, multi-asset, lower risk but lower return, and then fixed income, etc.
Yes, you're right. So that's exactly the reason why. Because our focus was a lot more on risk and drawdown. What we've consciously taken a decision is that within the equity space, we will be restricting our portfolio to large caps and mid caps.
Okay.
And not taking an exposure to small caps.
Sure.
So for now, the view is that we're only going to be restricted to large cap, mid caps. If this itself is giving us, a return stream which is closer to this, then we don't need to increase risk in the portfolio by taking exposure to, let's say, smaller names.
Top 250 stocks.
Broadly the top 250 stocks. Yes.
Okay. The commodity sleeve is also interesting because instead of just gold or just gold and silver, you're also doing copper
and crude.
And crude oil.
Yes.
What does the starting allocation indicate? What would be the commodity?
So, so as of today, let's say what our model shows up, okay, is broadly an equity allocation of around 34%. A commodity allocation cumulatively across all the 4 commodities is around 21%. That has come off in the last few months. So let's say till a few months back, our allocation in the model was showing up to crude was around 8-9%, has now come down to 2-2.5%. Copper actually came down, it's just gone up a little. In fact, in between, our silver exposure had almost become zero. It just got added by a small percentage in the last few weeks. Gold continues to be a higher allocation in the model, right? Let's say around 10-11%.
Interesting, because the regulations say you have to have 10% in commodities, right? So that can be split whichever way.
Yes.
So Bhautik, the one question that almost every investor will ask you is track record. Why not wait for another 3 years while you guys build track record?
So let me kind of answer it slightly differently. So see, the point here is that technology is changing things very, very quickly, right? So one is on existing track record. It's not that we are new to the market with no public funds, right? So we already have a SEBI-regulated PMS. We have a couple of AIFs, which are again SEBI-regulated. So that track record, one way or the other, is available to people. Right? And that's a good 4-year track record that's available today. Other thing is that pedigree of the firm. Okay, so as a firm, at least we have a 16-year track record of being successful, not just in India, but now being successful at a global level. Right? Considering the firm has it's connected to 30 exchanges, we pretty much trade multiple asset classes. Okay.
You are a hedge fund in the truest sense.
I can say that. The other thing is that what we have to understand is, if we just keep looking at historical track record, that's like looking at the rearview mirror. Okay, and the world is changing very quickly. To take an example here of how quickly the world is changing, all of us have started using AI in one way or the other. Right, and one of the tools that the tool end up using is Claude. At least I use that extensively.
Me too, a lot.
Right, and the company which owns Claude is Anthropic. Okay, technology company. Very recently, I think less than a month back, they did a fundraise. If I'm not wrong, what I read in the papers is they raised at a valuation of around $960 billion. Okay. Now let's look at this. A 4-year-old company, which has 5,000 employees. Okay, is now valued at around
almost $1 trillion.
Almost $1 trillion. Okay, at a technology company. Now let's look at our technology companies. Okay, which is our IT sector. Right. Our technology companies would be, if I'm not wrong, all of them have a history of more than 25-30 years. Right, the top 5 at least. Cumulatively, again, if I'm getting my numbers right, they employ around 15 lakh people. Across the globe. Right. The cumulative valuation of the 5 companies, which are all technology companies, have a history of more than 30 years. Okay, is less than $400 billion today. That's how quickly technology is changing things. Which means that if we are not early adopters and not adapting with the market, right, it's highly possible that we may miss out on certain trends in the market, right, and we may try to catch those trends way later.
As investors, also one can become a dinosaur.
Exactly, that can definitely happen, right? So yes, there is a requirement to, in some sense, change the mindset of how you look at investing, right? Yes, we are not a star fund manager, approach, but this is more about thinking about a particular process, and do you trust the system, do you trust the process, is what we are trying to do out here using technology and data.
So Bhautik, last question. If there are 3 reasons why investors should invest in this fund, what would they be?
So one is the historical backtest track record. So it clearly shows that allocating to the right asset at the right time can, it's not necessarily give you mediocre returns, but at least the backtest shows you're getting equity plus returns, which is around 14% CAGR versus 11 on Nifty, with far lower risk. Right? So I think that makes a big difference for any client. In our view, this is more like a fill it, shut it, forget it portfolio, right? Or like an all-weather strategy.
Sure.
The second thing is the dynamism that we have, right? The flexibility to go from a 10% to 60% on equity, similar on fixed income, a 10 to 40% on commodities. And within commodities, we're just not restricted to gold, silver. We have the ability to invest in crude, copper. So these are, to our mind, gives us more diversification. So that's the second thing. The third is AlphaGrep's pedigree, right? Like, I think it has some meaning to be doing this for 16 years in India, global markets, having been successful. So it's in some sense, it's institutional grade, infra capabilities, people capabilities is what we want to bring to the retail investors.
Basically a hedge fund going democratic.
Yes, you can say that.
Bhautik, thank you so much. It was a pleasure having you.
Pleasure. Thank you so much. Pleasure is mine. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.